Hi everyone, welcome to Behind the Sign. I'm here today with Matthew Woolnough from WR Accounting and Advisory, just talking everything real estate and accounting, tax, and what's been happening with the federal budget.
Yeah, thanks, Grant. There's obviously been a lot of discussion since the budget, and a lot of people nervous about what changes and what hasn't changed, what it means for investors, and how it applies for existing properties, new properties, and other segments of the property market. So, yeah, it's good things to be happening, and probably some things that need to be looked at and changed in your investment model going forward.
Obviously, until it passes legislation, we're not really aware what the final impact has been. But when you look at things like negative gearing, everyone gets upset that it's potentially being removed. But ultimately, negative gearing isn't an investment strategy. It's just potentially saving a bit of tax. But what are your thoughts around making decisions around investments? Should they be based purely on tax?
Oh, absolutely not. You shouldn't be chasing a tax break because ultimately you've lost money to achieve that tax break. And I guess over the journey, for the longest period, people have probably been hoping their capital growth on the property has outpaced the negative gearing losses on a year-by-year basis. So you should be looking at, I guess, growth factors, what the property is going to potentially grow by in capital value, versus the year-on-year negative gearing losses. That's traditionally what people have done, but as we've seen through the budget, those things have changed as well going forward. So you can only get negative gearing on new properties. On established properties purchased after budget night, that's gone. On residential properties, and then when you sell, the 50% discount's gone from 1st of July 27 as well, and that's a bit of a mixed model. So the gains up to 30 June 27 will be grandfathered to be 50% discount, and then after that it'll be an indexation model with a minimum 30% tax, which is quite an impost, which will change the position for a lot of people. But anyway, that's what's mooted to be eventually passed in legislation. So
does that mean necessarily buying in your own name is off the table, or do you think people will use different structures? I know self-managed super funds now can't borrow for residential property, but is it family trusts or is it investment companies? What way do you think would be best way forward for the average person to invest in residential property?
Well, family trusts appear to be very much off the table because there's a minimum 30% trustee tax at the trustee level, which is not passed through. So I guess using adult kids as beneficiary distributions is gone because you've got to pay the 30% tax, and it gets passed through as a credit, but it's a non-refundable credit, so you potentially lose a great portion of money, and then there's no pass-through to investment companies. So I've already seen some clients moving property trusts holdings out of their family trust into a straight investment company. So the profits from the property trust, are flowed straight through to the investment company rather than via a family trust and give you that previous discretion that we used to have as accountants.
But I would argue that any investment should be made long-term anyway. So if you're talking about using an investment company and paying less than 25% tax, if it's a long-term play, the capital gains is still charged at the 25%, isn't it?
Correct, and companies don't have that, never had the discount, so that whatever profit they have, they pay tax on. So whereas individuals had a 50% discount, companies never had that anyway. So that's probably why they're becoming more popular for the holding vehicle for property going forward.
Obviously, we're talking about going forward buying from now, but for people that already hold properties pre-budget night, there's an extra level there behind, because obviously they can still negative gear going forward. To me, it doesn't make sense for anyone to rush out and sell that asset. It long term could be one of the best investments you'll ever hold.
Oh, absolutely, Grant. So looking at a few clients' positions, anything that's currently negatively geared, my suggestion has been to go as slow as you can on paying that debt off, or go interest only, and then look to use that equity to purchase it. If you want to purchase a new property, actually look to then use that to be going in as positively geared. So you're keeping the old ones as long as you can as negatively geared, and looking to be positively geared on the new ones. And the other thing in the legislation is what it really means about negative gearing is you can't offset it against your salary. So if you're on 120,000, you lose 20 from a rental property. Before you would have paid tax on 100, like you earn 100,000. Now, if you have a negative gearing property after budget night, that 20,000 doesn't get lost. It sits in your tax return quarantine until such time as you actually make rental gains from other properties if you own more than one, or you eventually that property becomes positively geared. You start to chew up those retained losses over the journey. And we haven't seen what that looks like from a tax return point of view, but that's loosely how it's supposed to work. So if you've got property that's negatively geared under the new rules, you want to look to offset those against other rental positively gained properties. So that's how it's mooted to work going forward. So you want to look to keep the old ones as negatively geared as long as you possibly can, and either try and buy positively geared new ones, or making sure you actually manage your numbers so that you actually make a little bit of money, or keep the old ones basically.
So perhaps it's a good time to get an appraisal and an update of what you currently own, leverage that against it, and potentially look to reinvest into newer markets, newer properties, potentially commercial, but yeah, make sure that you don't necessarily rush out and sell that retained asset.
Thinking of selling this spring? Book a free appraisal with Raine and Horne Wagga and receive a $50 Rules Club voucher. And if you list with us this spring, you could win a $1,000 Visa gift card. Talk to the people who love where you live.
As I was saying before, Grant, your biggest thing coming 30 June next year with the change in the 50% capital gains discount is everything will need to be valued. So you guys are going to be horrendously busy from probably any time from now certainly through to 30 June next year to actually get a value on the grandfathered 50% discount, because after that any gains are then taxed on an indexation basis, which won't be as generous for tax saving, and with a minimum 30% tax applied. Even if you're in a lower tax bracket, as you start to retire and sell down your assets, there's a 30% whack on there. So for investors on all property, you need to be looking to get your stuff valued running into 30 June next year. So
it makes sense to even approach your bank and potentially refinance now, see what your equity position is, and potentially use that as deposit for something else going forward.
Absolutely, yeah. You probably want at least a real estate valuation, because they'll be probably fairer and kinder than a bank. Banks obviously take a very dim view about what they can skin it for if they have to. If you go pear-shaped, so they take a lesser view of the value of the property compared to what actual real estates do, because you guys obviously see the market, you see it moving and see where it currently is, rather than what the bank might get if they have to sell up on you. So look to get and it costs you money, but ultimately it will save you tax in the long run if you get a decent valuation on your properties running to 30 June next year. So
yeah, it'll be interesting to see the legislation get passed and whether agents can actually provide the information for the ATO for those reasons, or whether we need to rely on sworn valuations. But regardless, I think it's good to know what you're sitting on, and if you're interested in appraisal, reach out to any of the team here at Raine and Horne. Thanks for coming in, Matthew. As always, this is all low-level advice. Each individual case is different, but if you are interested in anything advice-wise, or you're looking for an accountant to guide you through the coming years, Matthew and the team at WR Accounting Advisory are always on hand.
Thanks, Grant. Yeah, as Grant alludes to, every position is different, so what your mate might be doing can be completely different to you, because obviously people don't discuss what they're up to, and every property is different. You want to look at the investment returns, both the year-on-year rent, and then versus the expenses and the potential for capital growth. And if that's not there with all the capital growth that's gone on, you need to be more selective about which ones you look at going forward, I think.
Thanks, Matthew.
Thanks, Grant.